Welcome back. Well, it's quiet for the equity markets now, so let's shift focus onto the macros. The Reserve Bank of India has announced that its balance sheet for the financial year ended March 31st, 2025 increased by 8.2%. Latha is here to discuss more about it. Latha.
Well, first, I'll just run through some very interesting things that we've got from the RBI annual report. The RBI has bought more gold. It has bought 54 tons more gold. So the total value of its gold has risen by 57%. That's more because of the rise in gold prices, but it also bought 54.13 tons more gold, and so its gold holding rises to 879 tons. A table will come up for you. This is higher than previous years, that is year 24 and 23, but it's not the highest, you know. In FY22, they bought 65 tons of gold and the percentage increase was something like 9%. This time the gold holding has increased by 7%. Now, the other important takeaway that I got from the annual report is that, as already announced, the Reserve Bank has raised the contingency reserves, the reserves that they hold if, you know, the value of gold falls, value of dollar falls, all that they hold if it falls, you have a contingency reserve or buffer. That was increased from 6.5% to 7.5% in a previous board meeting. If it had remained at 6.5%, the Reserve Bank could have declared a dividend of 3.6 trillion. But because it has increased the reserves, an additional 76,254 crore had to be transferred. That's another interesting takeaway. Otherwise, the dividend would have been super, but maybe they're reserving something for this year. The other takeaways on the economy front, the Reserve Bank has an economy outlook chapter where it points out that the global outlook is very bleak. Advanced economy growth rate has been scaled down from 1.8 to 1.4%. And even the global disinflation advantage which we had seems to be going away. It's moderating. But the Indian economy is strong, supported by revival in consumption. Capex push is continuing. Very clean balance sheets of corporates and banks. Easier liquidity conditions are all leading to good growth expectations. Given the good monsoon, they're also expecting inflation to remain below the 4% mark. Those are some of the key takeaways. There are very interesting details on what kind of notes are in circulation, how many frauds have been done. Total number of frauds have fallen 33%, but in value terms, it has almost doubled. Although the number of frauds have come down. So interesting details. Let's get some more asides from the annual report. We have a guest joining us. Indranil, the chief economist at Yes Bank, joins us. Indranil, good morning. I know it's just an hour you had to look at the report, but what were your key takeaways first in terms of the dividend? Do you think they are gearing up for a higher dividend this year?
That's a very difficult sort of call to take at this point in time, whether they're gearing up for a higher dividend. But no doubt the risk contingency buffer has increased, and I think the total as a proportion of the balance sheet, it is now 7.11% compared to the 6.05% that was there the last time. This I am talking about the total risk provisions that have been done. Now, the global atmosphere in terms of the risks are quite volatile, and that is possibly the reason why the economic capital framework was widened to take care of the risks that might actually happen. My sense is that next year we might actually get a relatively lower sort of dividend, because in terms of the income, if we are not expecting the significant volatility in the forex markets continuing to in this year vis-a-vis the last year, and therefore a huge amount of sales by of FX reserves that have happened, the income from the foreign sources in terms of the buy and sell of dollars may actually be lower. So that's one thing. The other thing to remember is that in the fourth quarter specifically, because of the huge amount of liquidity infusion that happened from the government of India, the interest earned on these LAF has actually increased. So these are some things we need to watch out as we go ahead because of the huge amount of uncertainties that are there in the system.
Fair point. Even otherwise, the amount of government securities they own is going to fetch a lower interest rate because Reserve Bank has been cutting interest rates. As well, what they lend out by repo in MSF is also going to earn less. I take your point that probably that is why they've given themselves a 7.5% reserves. They can reduce it all the way to 4.5, even if they reduce it to 6.5, that can perhaps give them another 1 trillion rupees, which can make up for the loss. Indranil, there is also a detailed chapter on the outlook of the economy. Any key takeaways? Are you feeling as confident about the domestic economy as the Reserve Bank seems to be suggesting?
Yes, the resilience in terms of the economic growth continues. But whether we actually see an upside in terms of the growth numbers is something that is very difficult to decide at this point in time. Now, on one side, sort of if tariffs are avoided, because we have seen the trade the trade ruling from the Reserve from the US, which
US
says that most of the trade tariffs are unconstitutional, is what they say. So if the tariff threat is reduced, then possibly the US avoids a recession, and along with that, the significant proportion of the world avoids a significant lower growth, and therefore exports dynamics are likely to be on the positive side. So that's one perspective to look at. The other thing which is very important is that for the current financial year, we are definitely looking at investments being the leader in terms of pushing growth. We are looking at more consumption in terms of pushing growth. One, because of the lower interest rates of the government. Two, because of between even the rural versus the urban, the rural is likely to be picking up. That's what most of the survey results tend to show at this point in time. The direct implications of a good monsoon and the agriculture will be felt on the GDP. The indirect implications will also be felt in terms of the higher income generated for the rural segment, as well as a fall in the general prices of the food items. So that is also a positive in terms of the demand story going forward. So looking at the more holistic picture, I think we are penciling it in a 6.5% growth for the current financial year, compared to our full year estimate of 6.4% for the year gone by, which necessarily means that yes, there is resilience, but the upward momentum may actually be missing. Of course, I did forget to mention that I'm not really hopeful of private capex building up, even though interest rates are coming down, unless there is a clear visibility in terms of the tariff structures, the implications of that in terms of both the domestic sort of demand as well as the external demand.
Okay. So GDP growth likely to be better than last year, inflation likely to be lower than last year, and that itself is a very positive trajectory. But private capex may not pick up. Is there anything else in the annual report that we should pay attention to? I mean, we have got very interesting trivia in terms of the number of frauds declining, but the amount of value of frauds are higher. There is such interesting trivia, but any other takeaway from the annual report?
No, possibly. I think I wouldn't want to comment on the frauds thing. It's very difficult to have read.
No, anything outside. I just meant key takeaways.
Yeah, so I think the key takeaways for me would be also, apart from the annual report, in terms of the overall projections and the direction of the economy that they are looking at. And this gives us confidence that given that the inflation is now below the 4% handle, and the RBI is also looking at household inflation expectations coming down, and a durable consolidation of inflation below the 4% handle. They possibly have a scope of going much deeper into the rate cut if that is needed, given the growth inflation dynamics that pans out through the year. So we are currently penciling it about 75 basis points, June, August, a pause maybe in October, and then one more last one in December is what we are penciling it at this point in time.
Okay.
The other interesting fact is the fact that the balance sheet size, the Reserve Bank's balance sheet size, has grown at only 8.2%, which was growing at 11% last year. And that could also have its implication in terms of the domestic deposit cycle. So that's something that we need to sort of understand, because it also directly influences the reserve money growth. Yes, reserve money growth has become relatively better with all the durable liquidity infusion from the Reserve Bank of India, and we need to, and I think the Reserve Bank of India needs to take a call now whether they need to push up the balance sheet and the reserve money growth to facilitate growth beyond the rate cycle that they are anyways into.
Fair enough. We'll have to wait and watch. We will perhaps hear from the Reserve Bank on June 6th. Thank you very much, Indranil Pan, for your preliminary observations on the RBI annual report. Basically, a very strong word for the Indian economy. Worries, of course, global, and nothing new in that. I think it's more the trivia that are interesting, the amount of gold, the amount of frauds, and the fact that the Reserve Bank has kept this huge reserve, 7.5%. They have, 4.5 to 7.5 as the range. So in case they earn less from government securities because interest rate has cut, both in the US and in India, they can always make up by reducing the reserves. So it looks like it's prepared for a good year.
Okay, all right, Latha, thanks very much for that. We'll take a short break, but before we do that, just keep your eye out on the Bank Nifty, which is now down around 280 odd points, down around 0.5% as we speak. There is some pressure which is seeping into the banking stocks. We pointed out stocks such as Kotak Mahindra Bank as well as HDFC Bank, ICICI. All of these stocks are currently trading anywhere with a loss of around 0.5% to 1%. We'll take a short break, but we'll get you more on the markets as well as commodities on the other side. Stay tuned.